This week in the Boardroom, brought to you by NYSE Governance Services Corporate Board Member, along with Governance Knowledge Partners, the Center for Audit Quality, and Grant Thornton, and contributing partners, National Investor Relations Institute, and the Society of Corporate Secretaries and Governance Professionals.
Welcome to this edition of This Week in the Boardroom. I'm TK Kerstetter with the NYSE Governance Services Corporate Board Member, and it's my pleasure to welcome you to our show today. We're going to be talking about short-term focus, what we're affectionately calling today the 900-pound gorilla. And joining me to deal with this discussion is John Lukomnik, who is the Executive Director of the IRC Institute. Welcome, John.
Thank you very much, TK. Thanks for inviting me.
It's my pleasure, and we've known the IRC Institute, or at least its early stages, for some time, but I'm not sure our audience is completely familiar. So let's start by just taking a minute to sort of explain to the audience what the IRC Institute is.
IRC Institute is a sort of unique nonprofit research organization. We originate, fund, quality control, and disseminate research at the nexus of sustainability and the informational needs of investors. But this is not corporate-specific research. It is not proxy advisory research or that sort of thing. It tends to be systemic. What makes us unique are a couple of things. First off, we're passionate that our research be objective and unbiased. We are not advocates. We have often seen on proxy access, on political contributions, and a host of other issues, our research being used by both sides in rulemaking. And for us, that's a success because people may have their political beliefs, but at least they can argue off of an elevated fact base. We do no research in-house. In fact, we are the epitome of small, nimble, and efficient. We have less than one full-time equivalent. I work half-time on this. That has a couple of interesting things. First, we can be relevant and quick. Second, since I have a consulting practice, it means on the side, it means that we're aware of what's going on in the boardroom and on the trading desks. And so our research is not stuck in last year's problems. Third, and I was unaware this was unique until someone pointed out to me 2 years ago, we fund both practitioner and academic research. So we like to think that our practitioner research is held to relatively high standards, and we like to think our academic research is relevant. And last, we don't engage in any fundraising. The board, in what I think was a very wise decision, chose to make this a finite-lived organization. We will go out of business, depending on what your capital market assumptions are, sometime around 2020, 2021. That means that not only do we not expend any resources on fundraising, and we can focus entirely on trying to generate quality research, but neither are we beholden to any fundraisers. So the short answer, that was a very long answer, the short answer is we fund objective research around environmental, social governance, and capital market issues, and preferably things that kind of cross those on a systematic basis. The long answer, what makes us unique, are those 4 or 5 attributes.
Well, it's a pleasure to have you. And again, my experience goes back to for some time with the IRC, and you're right, it's always been passionate based. So it's a pleasure to have you. So let's talk about the short-term focus. What was interesting to me when I was doing the research on this, in June you were presented with the prestigious award for the Excellence in Corporate Governance, which is annually given by the International Corporate Governance Network, the ICGN. And I was intrigued on your speech, sort of the acceptance speech that you gave, and because you talked about your concern about the short-term focus. And it seemed to me that it's obviously something that's very important. I'm always concerned that there is never any headway with this, and if there was ever going to be headway, it seemed like it would be during the financial crisis, and we made no headway. But you raised concern that you would hope that something could be done to change the financial ecosystem. So I know I just threw a lot at you in the way of a question, but I really want you to talk about your passion relative to this short-term focus issue, which we all have a concern with, particularly those that are sitting on the board of directors.
I want to get to the board of directors, and I've been a corporate director. But I want to start back a little, because I think the context is useful and enables you to understand how I get there. Everyone thinks that investors are more short-term oriented than ever, right? We can see the statistics, depending on which set of statistics you believe. Average holding period of a New York Stock Exchange stock has dropped from 10 years in the 30s to a matter of months, say 6 months, 9 months, different studies. The reality is we have different types of investors today. And the average stock is a very misleading statistic. When 51% of American shares are traded by high-frequency traders who can trade in 3,000ths of a second, right? I don't know what it means when you can price IBM 18,000 times in an hour, but you can do it. It's sort of like a wedding cake. You have a very frothy icing, but that doesn't mean that the filling has changed at all. It just means that there was no icing ever before, and so when you add it all up, that distorts the averages. In fact, Martin Kremers, a finance professor at Yale, has done a very interesting study that basically says mutual funds have been holding for the same time period for 20 years, more or less. I mean, between 1.2 and 1.5 years. Now, having said that, I don't know that 1.2 or 1.5 years qualifies as long-term either. I mean, to quote that famous 1998 annual report of Warren Buffett, our favorite holding period is forever. And I think there's some wisdom there. It's not to say put it away and forget it, but that you want to find managements and companies that you could hold long term. And my background is as a pension fund investor. I used to run New York City's pension funds. And you want someplace to put $80 billion that earns above the rate of inflation forever. So that's my background. So I don't know that, so the first point is I don't know that investors are more short-term now. I think there are more short-term investors. But if you ask any CFO or head of IR of a large company who your top 20 holders are, they know them and they haven't changed much from quarter to quarter. That doesn't mean there's not short-termism. It's just let's figure out why there's short-termism. And I don't know that it's because investors are more short-term in their trading. Now, as a longtime shareholder activist, I think I have credibility to say the following. That doesn't mean investors are blameless. The question is, how did the trend, if 20 years ago mutual funds were holding for a year and a half, why, are recent studies saying that 3/4 of corporate executives would pass up a net present value positive investment if it means blowing a quarter? Why are we so sensitive to quarterly expectations? And there I think we investors can share the blame with a lot of people. And the question is sort of if investors have always had, let's call it economic ADHD, how did it jump species into the boardroom? How did it cross the line? And I think the answer is executive compensation. We were so anxious to align, or in theory, and I disagree with it, but in theory, align executive compensation and pay for performance that we have insisted on equity-based performance. Well, if you're giving an executive a half, 2/3, 3/4, 90% of their compensation in something that's denominated in a stock price, they're going to pay attention to the stock price. And I do think it is, not for the reasons that former SEC Chairman Chris Cox said, 162M, which is the IRS reg that gave rise, in effect, to widespread adoption of stock price. He said that law, which he was in Congress at the time it passed, deserves to have a pride of place in the Museum of Unintended Consequences. I think he was just talking about the level of compensation. I think it has also changed what boards and executives think about. They think short term. And this is far from an original thought. I mean, Ray Gilmartin, the former chair of Merck, just said this a couple of weeks ago, that he thought that the compensation in equity-linked compensation has greatly increased the attention that boardrooms and CEO suites pay to stock price as opposed to really driving long-term value.
So the whisper number that everybody's concerned about, and you're seeing people not give guidance anymore. So what happens? How do you change the ecosystem? What any recommendations?
I think there are a couple of things. The first is directors ought to start looking at who their holders are. You'll see the same 20 names come up holding 50, 60, 70% of your stock, and you start to realize these sort of are long-term holders. Second, whatever you may think of Say on Pay, and whatever you may have thought of Say on Pay before it came in, the one thing that seems pretty universally agreed upon is increase the amount of communication and engagement between material institutional investors and corporations. I think that's a good thing because it gives you an opportunity to say, look, we want to pay people based on building value for the long run, and in effect inoculate yourself against the, but you were down for the quarter. You can actually, in effect, both inoculate yourself on the pay and to some extent, I think, select your shareholder base a little bit better than people do. There's a great example of this. It goes back about 20 years, and I was always wondered why it didn't happen more, and I think the answer is that shortly thereafter, Reg FD came in and scared everyone. Kirk Kerkorian made a run at Chrysler in the mid-90s, I believe it was. Bob Eaton, who was then the CEO of Chrysler, went to a meeting of the Council of Institutional Investors, said, it's true we have $6 billion on our balance sheet. Here's what we're going to do with it. We're investing in what were then the KCAR platform, for those of you old enough to remember. That saved Chrysler for a number of years. And the result of Bob Eaton coming was 22 of his largest share owners wrote a letter to Kirk Kerkorian basically saying, go away. I think that Say on Pay gives boards an opportunity, if they have a long-term, value-driven investment scheme, investment plan, to make that strategic plan known to the shareholder base and possibly get buy-in. So you don't have to respond to, in effect, the daily price volatility in the marketplace as an indicator of whether or not shareholders buy in. You can actually tell them and ask them.
Well, we're eating up our time here, but I really
I
really wanted to make sure that we have the opportunity. Like me, you have some 30 plus years in this related board space. So when you look today at the boardroom and at corporate directors, what sort of encourages you about what you see, and what still raises concern for you? And you got about 30 seconds with each. So,
what encourages me is directors are just much more professional. There are more resources, you and some of your competitors. Directors spend more time. They know they have to come prepared. It doesn't make it anymore to read the board book as the presentation's being done. I know I'm a director, and I probably spend at least 2 to 3 days in prep for every board meeting. Second, the selection of directors is much more professional. People understand they need a balance of independence in all aspects of what independence means, and domain expertise. There are, gone are the days when O.J. Simpson is on an audit committee. There are very few celebrity directors. What concerns me, there's broken trust still between the corporate executive suite and the directors on the one hand, and many institutional investors on the other. I think it is being repaired. Maybe I'm an optimist, but I think the increased communication, the increased engagement, programs such as this, meetings at the NACD, meetings at the ICGN, meetings at CII, enable people to see each other and understand that everyone's trying to do a good job. They may have differences of opinion, but we're all human. We have frailties. We make mistakes. But institutional investors don't have, horns growing out of their heads and red tails, and neither do CEOs by and large. And once you stop demonizing the other side, you have communication, and then you try and figure out mutually positive solutions. So that gives me some hope.
Well, that is certainly why we're all here, to make it better, and I share your hope.
Thank you.
So, John Lukomnik, thank you for spending the time with us today. And that will conclude this edition of This Week in the Boardroom. We hope you enjoyed the show. We'll be back again next week when we take a look at another critical topic that'll help you be a better board member or committee member. So we'll see you then.
Join us again next week for This Week in the Boardroom, brought to you by NYSE Governance Services, Corporate Board Member, along with Governance Knowledge Partners, the Center for Audit Quality, and Grant Thornton, and contributing partners, National Investor Relations Institute, and the Society of Corporate Secretaries and Governance Professionals.